Good afternoon, everyone, and a very warm welcome to today's webinar, which is titled Transform Your Financial Reporting, Latest in IFRS Standards. My name is Manali, and I am a conference and training producer from Informa. It's a pleasure to have you all with us today. As financial reporting continues to evolve, staying updated with the latest changes in international financial reporting standards is more critical than ever now. And this webinar is designed to help you navigate the recent updates and understand their implications for your organization, especially in the context of the MENA region, where IFRS adoption is accelerating. So, whether you are in the process of implementing IFRS or have already adopted it, today's session is going to provide you with valuable insights into latest changes in the IFRS standards, their impact on financial statement presentation and performance metrics, and practical approaches to address the implementation challenges, etc. So, and we are honored to be joined by two of our distinguished experts in this field, which is Dr. Arif Ahmed and Professor Veena Hingarh. So, Dr. Arif Ahmed, he's the director at South Asian Management Technologies Foundation. He's a chartered accountant from both the UK and India. Dr. Ahmed brings over 30 years of experience in finance, risk modeling, and sustainability. For Professor Veena, she is also the joint director at the same South Asian Management Technologies Foundation. She's also a chartered accountant and company secretary with 25 years of experience, also serving as an independent director on listed company boards and specializing in areas such as forensic accounting, corporate restructuring, and WA tax regulations. Together, they have trained and consulted for global corporations across industries and have served as advisors to the World Bank and the Institute of Chartered Accountants of India. So we are excited to learn from their expertise today. Please feel free to use the Q&A box throughout the session to share your questions or the chat box. We will address them during or after the discussion as the trainers deem fit. So let's get started. Over to you, Professor Veena and Dr. Arif.
Thank you, Manali. Thank you.
Thank you.
Good morning, good afternoon, good evening, depending on whichever part of the world you are joining in. And thank you so much for joining in this particular workshop. What we're going to do here, as you all know, IFRS is not only challenging, but it is also voluminous. It spans through a number of standards, having different focus areas, and recently having different industry focuses also. So what we're going to do is we're going to focus only on the issues which we think are critical for all of us here who are practicing in the field of IFRS implementation or interpretation or using it in any way, particularly as a source of information. What we're going to do here, we're going to bring up a presentation. We will run on the presentation for all of you. And we will see what are the primary areas of change that we should be looking into. So let me just start the presentation. Great. Okay. So as we have the presentation on the screen here, so we look into what are the areas we're going to talk about, that what are the most recent updates that you can see here. Right. So the areas that we are focusing on are these primarily areas, and you can see we have given you an effective date. The first one we are talking about is an IS 21 amendment, which talks of lack of exchangeability. This is effective from this year. It's already effective, 1st of January 2025. Then we have IFRS 9 and IFRS 7 talking about classification and measurement issues, which is effective from 1st January 2026. We talk about some of the derecognition of financial liabilities. We have sundry standards that are moving around, which is the annual improvement effective next year. IFRS and IFRS 7 and 9 amendment of nature-dependent electricity, contract referencing, again effective next year, 1st January. Perhaps one of the most debated and sought after areas that we are looking into is IFRS 18. In fact, introduction of IFRS 18, which is starting from 1st Jan 2027. But don't uh, get the false comfort of this is being 1.5 years away. There's enormous task that all of us will have to do. So that's an area. And then again, IFRS 19 subsidiaries without public accountability disclosure. It also starts from 1st January. So what we're going to do, though we will be primarily focused on IAS 21 here, but sorry, the IFRS 18 here, but we'll just touch upon these small areas that we have also identified in terms of the exchangeability, that is my IAS 21 issues here. So let's see what are we talking about when we are talking about the IAS 21. What's happening here, if you remember in IAS 21, the foreign currency translation, we need to arrive when we are reporting, when we are translating our performance to the reporting currency, we use a rate for translating them. So the major change that's coming around is talking about exchange rate always implicitly assumes that there is an exchangeability. But if I do not have a very clear exchangeability, for example, some of the countries in Latin America face this particular issue. So, what we're talking about, we're trying to say that how do I determine when a country lacks exchangeability? And then, given that, how do I assess the practical ability to exchange a currency? Now, if I am unable to exchange a currency, I do not get a reference rate. So I'll have to estimate that. Now, IFRS, as you have always known, is not concerned about your business practices. They lay certain broad rules by saying you would better be within these business practices. And so it did here. It talks about a methodology for estimating the exchange rate when the currency is not exchangeable. And we're also talking about use of observable market data, which may remind you of IFRS 13 clauses whenever they are available. And whatever we have done, we need to disclose them. Those we have estimated the spot exchange. If I have a reference rate, that's simple. But if I do not have a reference rate and have done some estimation, I must explain that methodology and what are my key assumptions that we have used there. So what would happen? This would be very useful or relevant for entities who are operating in countries that have currency restrictions. And if I have currency restrictions, and as you can see, the recent socio-political developments are talking about a lot of currency restrictions across various countries because of a political reason. But those nations, the companies do have presence there, and they need to. Some of them are international companies. So how do I do that? So that's why this amendment becomes very relevant for them, and even for multinational corporations who are operating on emerging market areas. So that's the importance of this IS 21 amendment. The amendment is there. You can jolly well go through that. But please note here that if I do not have a straightaway reference rate, I need to revert back to IS 21 now and find out that what are the additional disclosures I have made, sorry, regarding how we have arrived at this exchange rates. That's one major area. The other area, which is very interesting, and it was kind of upsetting a lot of people in the industry. If you remember IFRS 9, one of the most discussed, debated standard ever since it came in. And interestingly, if I'm not too mistaken, it's about 7 years of that we are seeing a new standard coming in. And I think you are the IFRS 9 and after that IFRS 18, both are going to have a similar kind of debate and discussions all around, exciting the entire community of practitioners and others here. One of the important part that came around, the concept of the payment changed. So what has happened? Earlier, we were sending a document or we were sending through a negotiable instrument and others, wire transfers took over. Not only wire transfers per se, it's now even getting replaced by transfers which are based on mobile phones, based on your electronic wallets, based on a blockchain, and depending on which territory you are operating, even on cryptocurrencies. So when do I, the law said, the rule said that I will recognize my liability, when I will extinguish my liability when my responsibilities under that I have discharged them. So what is the point of discharge if it comes through an electronic payment system? So IFRS 9 has gone on to clarify and said that if you have used a system where upon putting a payment order, you cannot withdraw it, you cannot stop it, you cannot cancel it, basically means you no longer have any practical ability to access that fund, then you can consider that your liability is effectively extinguished, assuming that the settlement risk is very insignificant. Now, when we mean insignificant, that does not mean it does not exist. It means that the chances of settlement risk leading to non payment is extremely remote. It's not the normal business practice. So, in those cases, you can extinguish your liability as soon as you have completed committing a transaction to this electronic system. Interestingly, we have another tool, not very used here, but a very practical one, that when you have a, a non-recourse feature, meaning you are going to get some money, you are going to get some money from somewhere, and then your right to receive the cash is limited to the cash flow from a specified asset. You consider very commonly SPVs. Now, I have the SPVs have issued an instrument, and I have a particular instrument from where I am expecting the money to come into me. So here we have been given an idea that what is the exact source for that fund to come to me. Now, why is this important? It's important because how do I classify them? Most particularly whether they would be uh, fulfilling the requirement of SPPI testing, that whether this money is coming to me is comprises of only the return of the principal and interest on money due or something else. So once we have those non-recourse features here, which means I cannot revert back to somebody else for any additional payment, and my what I'm going to receive is extremely restricted to that. Let's take a mortgage-based security. Though I have been promised something, but my income is limited to the earning from that mortgage base. So the treatment therein, identification for those structured instruments, that's one of the major areas that we are also looking into. This is the two areas. We also have something called contractually linked instruments, where my payment is again linked through a particular underlying contract. That could be a complex derivative through which I am earning money. Maybe I'm linked with a my earning is linked to a asset portfolio and a reference inflation rate. Let's consider. So this could be certain complex areas that we may need to focus on. So these are the areas which I think you can see some of the changes brought in, which are very exciting changes. Another of the area that has focused on is I'll just jumping here where the IFRS 9 and 7 talks about contract referencing nature dependent electricity, which basically is a green electricity, hydropower, solar power, uh, more than the hydro, even the solar power and the wind power generation, where I'm not very sure of the generation that I'll be getting here. Now, here, what they have done, this amendment now, they allows the PPA. I have a power purchase agreement in which the price that I'll be paying for the power that is being generated is fixed for a period, for designated period, this PPA is now recognized as a hedging instrument because the price at which I will be buying, though the quantity is not sure, I'll actually, the hedging item, which is the amount of electricity I'll be consuming, is a variable nominal amount because I'm forecasting my electricity consumption. So though that's a variable amount, earlier what was happening that I was having a certain amount contractually and I was hedging for the fluctuations therein. But here my my exposure itself is to a fluctuating amount. There's no certain amount that is frozen under the contract, but I can still use the PPA as a hedging instrument here. So I have a variable electricity delivery expectation and which is my hedged item, and my hedging instrument could be those PPAs. So these, I think, are two major areas, IFRS IS 21 and IFRS 9. The changes that you are seeing here are all effective this period, except the next one, as we wrote the PPA as a hedge, which will come from the next year, 1st January 2026. This is going to do a lot of impact. There are a lot of investments that are happening in green energy in the Middle East, in the African region, also a part of in the Indian subcontinent, though primarily in the Middle East and the Gulf countries, as well as in some of the African nations. So I think this is going to be an exciting area to see how my hedging transaction changes, because you may remember that the hedging helps in changing the way I present my profit. Though my total profit remains the same, but the way I make the presentation, that changes. But it's not only hedging that changes. The major change in the way we present the profit is coming from IFRS 18. And that's an exciting area. All of us are looking into. It is complex in some ways, it is confusing in some ways, but it is going to change the foundation of my financial reporting. The way I used to read my profit and loss, the way I'll be interpreting them, the covenants that the banks have issued, the analysts, their templates, they're all going to go through a major change. And let's now talk about this IFRS 18 and see how this IFRS 18 would affect the entire world of accounting that's under IFRS.
Right, Arif. So, looking into IFRS 18, Arif said that it's applicable from 1st January 2027. But if I really think about it, because it has a retrospective impact, I need to start on 1st January 2026 itself. Now, why did this IFRS 18, why did they come out with this? Because IAS 1 was there for ages, right? I think more than 20 years, IAS 1 was there, and it was going on, the first standard, right, to be issued. So why at all did they change to IFRS 18? When we read about it, it's giving the profit and loss account a little more structure. So when I am thinking about where does this IFRS 18 transform financial statements, it's not touching majorly the balance sheet or cash flow or statement of equity, but it's more concerned on the performance statement so that people and investors can understand about the company's financial performance. Now, since it no structure was there defined under IAS 1, this is the first time we're seeing a little bit of a structuring into the profit and loss account, which we'll look at in details as we go along. But before we do that, let's take a little umbrella view. There are three major changes which are coming with this IFRS 18. The first one is about structuring the profit and loss account that I talked to you about. And it's bringing in new subtotals, it's bringing in new categories of expenses. I wouldn't say bringing in the categories, but bringing in the way it's being presented, the categories of expenses. And uh, apart from that, it's bringing in something really important, which is going to affect all of us, is about the disclosures about the management defined performance measures. Now, this is a new term which has come in, which we will look into as we go forward. But what really strikes a person like me, who is there at the strategic level as a director of a company, how would it impact, or how would it impact the decisions coming from these disclosures? Since now we'll have it more transparent, we'll have to have it, all the details have to be presented. Reconciliation back to the profit and loss will have to be presented, which we'll see all the requirements. What it is really driving is investors can now rely more on these MPM because they will be able to understand these performance measures. Now, it may be through your investor presentations, it may be through any other written document like a press release. So, all of it would be addressed by this MPM requirement. The third requirement is about aggregation and disaggregation. Is it something new? Well, we always aggregated and grouped certain incomes and expenses, etc., when we were displaying it on the profit and loss account. But it gives again a direction, clarity on what things can be aggregated and what cannot be aggregated. And if something is obscured, some information is obscured, how do you disaggregate, or to what extent do you disaggregate that information? So these three changes are going to really transform the way the profit and loss account is going to look. Now, we talked about just three changes. Well, there are going to be much more you will need to do. Because if my grouping changes, if my P&L structure changes, I'll have to look at my system changes. I have to look at my trial balance. I have to look at the changes in my chart of accounts. I'll have to think about tagging of these accounts in my system. My MPMs, I have to collect all that data. I need to see how the reconciliation will be done. It will come under audit, so all the proper documentations have to be built up. So it's much more work behind these simple lines that have been written here. From the investor perspective, again, they will need to understand all this information. Of course, in the long run, I do hope that it would aid the investors' analysis of the company's financial performance, which is the aim of this accounting standard. Right. So let's go and deep dive into these. I wouldn't say really deep dive, but be aware about these standards because we normally deep dive deeper during our IFRS training sessions. And but yes, we'll have a little awareness about this standard. The standard, to understand the standard, we have to first understand what are the issues and why did this standard come about. Let's take a little poll, right, before we come to this standard. So let's take a little poll. Let me stop sharing this and I'll request Tahanun to give me the first poll and let's see what and where are we at today's level. Tahanun would be launching the poll. Yeah, the first poll comes up and it says, what is the extent of your knowledge of IFRS 15, 18? Because that will help me to probably go deeper or go a little more expanding, and will also make us realize that what is our awareness level. So it tells me that as a panelist and a host, I cannot vote. Right? So we are 67% are new to it, and 33% have a level of awareness. So that gives me a perspective. And believe me, I'm not an expert as well, right? Because it's so new. All of us are going into it in a new way, right? But that gives me, let me remind you, anytime you have any questions, they are always welcome. Just put them on the chat box and we'll be keeping our eye there as well, right? Because it's something really new which has come up. So what was the issue? You know, first, we didn't have standardized subtotals. When we talked about, say, operating profit, then it was seen by the study of ISB, which you will see on this little slide here. That little aspect here, you see, 100 companies they took up, 60 of them, they were reporting operating profit in 9 different ways. And you remember in IS 1 and in the conceptual framework to the average, they talked about comparability. Well, if each company is reporting it in a different way, how would they ever remain comparable? So they wanted to structure it in so that this compatibility, transparency, the relevance, the reliability, all the basic aspects gets enhanced. Now it says that there were certain doubts. People talked about what about the profit and loss of a joint venture? Should it be in an operating profit? Or what about the defined pension liabilities, the interest cost that we pay? Should it be a operating profit? So all these questions came up and they were deliberated upon and they came up with this with change into IFRS 18. Now, is IFRS 18 absolutely new? I would say no. It's basically many aspects of IS 1, which is kept in IFRS 18 as well. Like, for example, the non current and current bifurcation, my definitions of asset, liability, incomes, and expenses still remain the same. The concepts of having, I would say, the frequency of reporting, comparative information, offsetting, capital disclosures, all these aspects which were there in IS 1 are going to be there exactly the same in IFRS 18 also. It's only these 3 major changes which have been introduced, and people are really worried because it will impact every entity reporting under IFRS. So when we come to these subtotals, there are 2 new subtotals coming up: operating profit and profit before financing and income taxes. So let me make it a blue color so that it's seen. Operating profit, profit before financing income taxes, and net profit, right? So 3 new subtotals are coming up. Now, what is the difference between these subtotals? If you can see over here, after operating profit, my incomes and expenses from investments are coming up. And that gives me a profit before financing and income taxes. Now, this is a very new line which has come up. And after the profit before financing and income taxes, we'll have all my financing related items like you have borrowings, etc., which we'll look into a little deeper as we'll go forward. And then you have to come to of course, the net profit after at the end. So there are two new subtotals. Net profit we already had before, right? And then you have these categories of income and expenses. Now, am I looking at a cash flow statement? Well, no, you're looking at the profit and loss statement. You have operating profit, you have investing profit, you have financing profit, right? And then you have two categories. One is from discontinued operations, which was there before also, and income taxes. So now you have five categories and you have two new subtotals, but total three subtotals, okay? Then it talks about something called main business activity. There are certain additional requirements for some companies, especially those in real estate and those who are in the business of financing. These are my specified main business activities, which they have certain additional requirements apart from this classification. Now, when I read the word main business activity, it puzzled me a little bit because across different standards, they've used different terminologies, right? Main business activity in IFRS 18, you have operating segments in IFRS 8, you have principal revenue in IS 7, and you have, like, I think, ordinary activity in IFRS 15. So all of them, are they the same? Now, there are minute differences, and our accounting policies have to clearly bring out what is the difference between my main business activity, my ordinary activity, my operating segment, and my principal revenue generating activities, because all of them may not be exactly the same. I'm not deep diving into it here because that will take a long time also. We have just introducing the concept to you. So that's something we have to be careful about.
Yeah,
And
Veena, there are a few
yeah,
questions I think few we have answered, and we may like to take them a little later. There's a lovely
okay, we
question that
can.
came from Norman on the
Uh-huh.
chat. I can read it to
Uh,
you. Is the nature
okay,
of expense? Yeah, you can see them?
uh, it says, is the nature of expense method
Yeah.
and functional method no more applicable? How does the structure look? I mean, format. I'm just addressing it in the next one.
That's right.
Next slide for you. Uh, it's a fantastic cue, Noman, because that's exactly where I will go. And I will also address the JVs and associates for you in the very next slide. So,
That's why I
but
flagged
very
them.
relevant questions. Thank you for those questions because, yes, it gives me the idea of addressing it in the next slide. So let me come to the next slide. And here we are moving here. So, Arif, in case I forget, do remind me about the questions, right? So we saw these three: operating profit before financing, and income taxes, and the profit. Now we have three segments: operating, investing, financing. How do we go about the segregation of the incomes and expenses into these three segments? The standard says that you first find out your investing income and expenses, then you find out your financing income and expenses, and whatever is left will be your operating incomes and expenses. So it's like a residual place. You don't find it in investing, you don't find it in financing, put it into the operating income and expenses. This is very unlike the concept that we had before, because we didn't have the concept of like a residual bucket where you would put everything in. Now, investing, addressing your question, Norman, any incomes and expenses which is related to any associates, joint ventures, or unconsolidated subsidiaries will go into investing category of my profit and loss. In addition to that, you may have cash and cash equivalents, and any incomes and expenses from these cash and cash equivalents would be coming under investment. So if you made an investment in a bank, it would be there under cash equivalents, and the amount would be here as well. And any other kind of an investment which can generate income, which can generate independent of your main operating activities, those will also come in the, I would say, it has to be related to some assets. Of course, the income that is generated will come under the investing activities. Right? And then we will find out which is my financing activities. So it's effectively all the incomes and expenses to borrowings. This may be the expense to get a borrowing. It may be interest expense as well. And you would have the interest elements of like leases, pension liabilities, etc., which will come under financing activities. So that investing and financing, whatever is rest, will go into operating. So this is the kind of structure that will look. Now, I want you to have a look between these two structures and spot the difference. Tell me at least 3 differences which have come up. You can put your answers in the chat box. I'm sure Manali would share the slides after the presentation because I can keep some reference slides for you then. Yeah.
Yes, it will be shared.
Okay, thank you. Right, am I seeing anything on the chat box? Spot the difference? Okay, so we have one answer coming up, operating profit. Yes, that was the much debated part. And yes, it has come up. By the time you're populating this, Nauman has a question. Let me address that. Is there a disconnect between rental portion under IFRS 16 that is classifying depreciation in operating profit and interest portion of lease liability under profit before taxes, okay, in the financing section, okay? So there is no disconnect with IFRS 16. If you look at IFRS 16 on leases, once you have recognized your right to use asset and your lease liability, these two are individually accounted in the future, right? Now, when a payment is being made against your lease liability, it is bifurcated into the lease rental portion and the interest portion, right? This interest portion is a financing part. The rental portion would be going towards the, I would say is still a part of my operating activities. Now, if I look at the second part of your question, which is telling me about, let me come back, depreciation, right? So you have your right to use asset. Now, the accounting for right to use asset is done separately, just like we did before. So you find the useful life and you would depreciate it across the useful life like any other asset in the category in which that asset belongs, right? So I don't, so there is actually no disconnect between IFRS. It's 16 is totally aligned with the requirements of IFRS 18. I hope I'm able to answer your question on that. It requires much more discussion, but I tried to do it in a short way. Right. And we have answers all populated. Let me have a look at this chat box in a big way because I can see disclosure requirements from JVs. We did have profit from JVs before disclosed as well. but it used to be disclosed in the operating profit. Now it would be in the investing profit. And
Profit from
so
financing and income taxes, Samir pointed out, Samir Musa. Adnan has come up. That's a lovely question, Veena. Adnan says for entities with cost plus markup scenario, would COGS still be valid as the profit? Would purely be the or it would be purely be the markup on the actual costs?
okay, now
That's a mix up of a costing question and a
yeah,
accounting
I
question.
got it right. Now in this cost plus aspect, okay, I need to ask myself, is there a deferred payment involved? If there is a deferred payment involved, that means there is a financing component there. That financing component would go into the financing profit portion. That would be a financing expense, right? The rest of it still remains as a part of my COGS here, right? Because that is the cost of my inventory, right? And yeah, coming back to the first question about the differences, Norman said, but under functional method, I'm coming to the functional and the nature method. I'll just come to it. You are correct. That used to be done earlier, where we used to take the interest portion under cost of goods sold. But now they have specifically mentioned that it will go under the financing cost. Okay. And cost per markup, I have done that. And you have another one. It talks about, yeah, these were the changes which are talking about. The GPs will be impacted as a result. Absolutely. And you see, even the GP over here, when I am talking about GP, and the focus is now shifting more to the operating profit. So I am really thinking, will investors be now focused more on operating profit and profit before financing and income taxes? Traditionally, we used to look at gross profit and net profit, right? So maybe some of the KPIs itself will require some changes to be coming in. So that is something I think. Even there was another aspect which Arif and me were discussing. Many companies had the profit before tax line, which is I have added here as an additional line. The ones in blue in color, these are additional subtotals. They have been added by me. The reason is many of the companies, we are so used to looking at gross profit and profit before taxes that even after this statement comes in addition to my operating profit and profit before financing income taxes and net profits, I think I would want to see these lines. And the standard is not saying that you cannot put in the additional lines. So this is something, yes, and I do agree there will be changes in the figures. Only once you get the real figures moving, you're going to have a look at what are the changes which are there, right? What I have done is I have brought in certain examples of, I did see some of you did write in the chat box, and we did have some discussions about relevant areas here. Now, some of the areas which I found are important, I tried to put it up here. One is about fair value gains on rental income from investment property. Now, this would now come under a investing category, except in case of real estate companies that would go under the operating category. So this is one major change that I'm seeing that will come up. And then we have another change that I see about these defined benefit liabilities. You know, they used to be the net interest expense, which is there. This was earlier in my general and administrative expenses. Now it's going to be in the financing part because they've specifically mentioned pension liabilities and lease liabilities, etc. So that is another change which will come. And you can see with all these changes, all our ratios are going to change. We have to redefine our KPI targets as we will go through these changes. And then we talked about JVs already. Just put it there for you as a quick reference. Now, foreign exchange differences which are arising from trade receivables or foreign exchange from any other categories, right? Whichever the base item belongs to, you have to put it there. So if it's related to investment, it will come into the investment profit. If it's relating to my operating side, it will go into my operating profit. If it's related to my financing, it will go to my financing. So it's very similar way I have to look to where does it belong and then put it out there. So if it was trade receivables, it will go away into the operating instead of a finance cost, which we used to put before, right? So I have to relate these foreign exchanges to their relevant category. And again, the same way, another example which came up here, right? So any other questions coming up before I go to the next part? This was about the profit and loss account. Can we have the second poll coming in? Yes, do you think IFRS 18 will improve the quality of financial statements? Especially my profit and loss account, because that's where the major changes come in. Okay, so significantly improve and moderately improve, but somewhere improve. That's what everybody is talking about. I think it will bring in a little more structuring. That's what I see. And probably I do agree that we still need some of our old totals because we are so used to it and our systems are so used to it. But slowly, I think it will move into a getting the benefit of this structure of IFRS 18, using it for communicating with our investors. I think that will definitely come in. Now let's look at the time is short. So let me, instead of chatting, I would say, let me look at the second issue. It's about management performance measures. And it's talking about different measures are being published by different people. And in a IASB study, they said 33% put some adjusted profits, 29% adjusted operating profits, 20% on adjusted EBITDA, and 11% on adjusted EBIT. So investors need to understand this and how they relate to the IFRS, what measure we have put in our profit and loss account. So it's asking for a reconciliation between what are the management performance measures that you have put and the data on your IFRS financial statement. So what is this management performance measure? Right? I use the word management performance measures and that the information should be used by the investors. So we need to be more transparent, which need to be more, I would say, to make reliability of the information that is there. So what are these management performance measures? Management performance measures, if we look into the definition, it says that they are those measures which have not really been asked for by the IFRS 18 or any other IFRS standards, but they have been written by the management. It's a management's view about the financial performance, and they have been uh, disclosed in writing, maybe through a management commentary. It could be through press releases, it could be through investor PPDs, and so on. So it is reflecting my management's view, and therefore there should be an explanation of why these MPMs are being reported and how they are being calculated. Only then they will be understood by the investors to whom this public communication outside the financial statements is being made. Again, it should be about financial performance, not listed by IFRS 18 or any other standard. Now, what it tells us to do, give me an explanation, give me a description about your MPMs, give me the reason why you bought these MPMs in, provide a reconciliation back, and also what is the tax effect when you made those changes in the MPMs. So MPMs need to relate to incomes and expenses. So if I have, say, a performance measure like a return on investment, it's not an MPM. I mean, a return on equity would also not be an MPM. And say, if I have something like somebody talked a gross profit, yes, it's a MPM, right? Because it was not asked, it's related to income and expenses, and it has been displayed by us, right? In the sheet that I had shown you, the profit and loss account, right? Let me go back here. So my gross profit and my profit before income taxes, both would be MPMs. Some companies would have EBITDAs. Some company may have some adjusted profits, etc., which we talked about here. So these are all MPMs. So what are not MPMs? If something is required by an IFRS 18 or any other IFRS standards to be disclosed, these are not MPMs. Or if there are any other performance measures, so something related to my balance sheet, or maybe free cash flows, to my cash flows, maybe net debt, return on investments, return on equity, maybe some financial performance measures like maybe a customer satisfaction survey. So these are all going to be coming into other performance measures, and they would not come under the heading of MPMs. So MPMs need to relate to incomes and expenses. The third change which came in, I know time is running short, I'll take 2 minutes to finish it off, is companies don't give enough information. Investors are always complaining that some things are being aggregated in to obscure, and the information they are trying to give is being obscured. So what it says, it gives you directions of how you're going to aggregate and how you're going to disaggregate. Now, the major things that come in, you're saying aggregate based on the shared characteristics. So it could be about the measurement characteristic, it could be about the structure, it could be any shared characteristic, you will be doing it, aggregating on that. So let me give you an example. For example, say financial instruments. You aggregate them. So you aggregated them, say, based on a measurement. So you had amortized costs, fair value through P&L, and you had fair value through OCI. And then comes the second question. You ask yourself, well, is this obscuring any information? So under the fair value through P&L, I have, say, equity fair value through P&L, and I have a debt fair value through P&L. Now, these are two very different kind of items and should not be clubbed together. So you disaggregate them. So the first step, take all your items, group them together, then take a test and see that do I need to disaggregate them to make it more understandable because they are having some unique non-shared characteristics, right? Now this will require a lot of thought, taking up your entire chart of accounts and going through them. But it also says that whenever you're doing it, please keep in mind that it should fulfill the role of your primary financial statements and the notes. Now, what is the role of primary financial statement? When I'm talking about a primary financial statement, what is it? It's a summary of my assets, liabilities, incomes, expenses, and cash flows, right? To provide what? To give an understanding, to give a comparability, to identify certain items which will be then presented in details in the notes. And what is the purpose of my notes? Notes are going to give whatever is the material information to enable my investors to understand my financial statements. And it basically supplements the financial statements so that their objectives are clearly communicated to my investors. So whenever I'm aggregating and disaggregating, I have to keep this in mind and not obscure any material information. Now, this is something we've always been doing. I don't know, they have brought it out very elaborately in this standard. But what really strikes me is about the labeling. It says like we label many things as a others category. It says you cannot do that. You have to have more informative labels so that people can understand what is underlying that, right? So grouping and labeling is something which has really been focused on, right? So that were the major changes that is going to transform the way we are looking at financial statements, transform the structure we need behind, transform our KPIs, bringing a lot of changes which we have to strategically think about. So before we go there, let's take a quick poll again. Can we have the third poll? Because I think I missed out answering a question about the function and the nature of expenses.
Yes.
Well, there is an option given in the standard that you can do by function, you can do by nature. But in case you are doing by function, there are 5 expense items that you have to clearly, I would specify items which you have to disclose. Those are depreciation, amortization, impairment, employee benefits. What was the 5th item? Write down or reversals of any write down on inventories. At least these items will need to be disclosed. Plus, you have to keep the test of aggregation and disaggregation there. And the best part of this is you can have a mixed mode. So earlier we had to have only function or only nature. Now you can do a mixed presentation as well. Okay, we have the poll results coming up. Need to develop further knowledge. I do agree with that. There's so many things happening there. Aware and ready to adopt. So everybody is really proactive here. So we are having a very good audience, very nice. So here we are coming back to our questions and almost to the end of the seminar. I did try to address all the questions during the seminar, but I would still be open to any other questions that you would have. How does mixed presentation work? Now, on mixed presentation, what happens when you have a functional, then you're doing like cost of goods sold, general and administrative, and so on, right? then if you are taking a mixed presentation, suppose you did revenue, you did cost of goods sold, you got your, I put an additional line item called gross profit, and then I want to show my employee benefits separately. So instead of clubbing it into a general and administration, I want to show that employee benefits. When I was in the nature, I used to do that. I want to show separately depreciation and amortization. So that is something that I can do here, right? Because you can use a mixed format. Gross profit will be, isn't it a part of OCI? Defined benefit obligations, what has happened is the interest element is going to come into the financing part for the pension liabilities, etc. This also brings the question, what about profit from non-controlling interest and OCI presentations? Those will remain the same, right? Because my non-controlling interest, if it is there, it's an investment, right? OCI and all that remains because we just bought in this part which is related to the profit and loss account, right? Earlier, we used to have this two structure, single statement format and dual statement format. The first state in a dual statement, you had the statement of profit and loss and the statement of other comprehensive income. So this changes are all related to your statement of profit and loss. Investments now in after, yeah, it is in the investing category, right? After the it says, but is an investment now in after operating profit from the earlier what was happening when you had this operating profit from JVs, this would be in your operating income. Now you are putting it into your investing profit and loss account. Okay, is there any other question that I'm missing out?
No.
Okay, great. But very, very interactive questions because it helps you to clarify and puts me to think as well because it's a new standard.
Right, and we do not have anything on the Q&A also. All of these were covered in the chat itself.
Yeah. So I think Manali has
Yeah.
given us.
Yeah, so thank you, Professor Veena and Dr. Arif, for the presentation. Really insightful. And thank you to all the delegates for joining. So, lastly, I would welcome you all to join our LinkedIn community, and this will give you an update and expert content and also notification about our upcoming programs to enhance your knowledge. So, this is the QR code. I request you all to scan this and join our community.
Thank you, Hussein. Thank you. Appreciate that you liked it. And thank all of you for the lovely questions that came in. Feel free to join the community, raise your questions there, and I'm very sure you will get some answer sometime there. Thank you once again, and all the very best.
Thank you. Thank you. Thank you, Professor Veena. Thank you, Dr. Arif.
Yeah.
Thank you,
Thank
Bye-bye.
everyone.
you.
Have a nice
Thank
day.
you
Bye.
so much, Manali, for giving us this opportunity. I know we always do all the in-house and the public programs on IFRS, but speaking on a webinar in a 1 hour duration was a different experience. So I've done it before, but I loved the questions this time. So thank you so much, Manali, for inviting us to this webinar.
Pleasure.
Thank you.
Pleasure. Have
Thank
a
you,
nice day.
Tangan, also
Bye-bye.
for all your help. Bye-bye.
Thank you. Bye-bye.
What if you and your team can be even more? Even more informed, competitive, accomplished, even more successful? With programs designed to inspire and empower everyone. to become even more. Introducing Informa Connect Academy. With hundreds of global, digital, and in-person training courses led by world-renowned industry experts, reimagining learning experiences for even more unlocked potential. Informa Connect Academy, available at informaconnect.com/academy.